All right, let's look back to this day in history, 2008, where I'm going to tell you how the municipal bond market got flipped, turned upside down, as bond insurers teetered, retail bond buyers balked, and the backstop of bank dealers threw in the towel. With no good in the neighborhood, it was on this day when we saw municipal yields from New York to Chicago to Hawaii surge to record highs. A $2.7 trillion market where defaults historically are few and far in between found itself reeling from a series of jolts that largely started back in February of that year when investors abandoned the auction rate market. Now, that auction rate system was crucial. It allowed municipalities to sell long-term debt at cheaper short-term rates that reset every 7, 28, or 35 days through bidding arranged by Wall Street banks. But a decline in the creditworthiness of the bond insurers like AMBAC, like MBIA, it rattled investors. All but 2 of the 7 top-rated firms that insured the tax-exempt market lost their AAA status as their other business of backing subprime mortgage debt was spiraling down in value. As a result, demand from institutional muni bond buyers evaporated. Insurance companies, they reduced their holdings, and mutual funds suffered weeks of outflows. And arbitrage funds, they just locked their doors altogether. Municipalities, hospitals, universities suddenly found themselves unable to raise money at all. By September 26, yields on long-term municipal bonds reached their widest compared with treasuries. Interest costs on new debt, as measured by the Bloomberg Short-Term Muni Bond Index, that climbed 5-fold in 2 weeks to a record of 8% or more. And the interest rates on muni bonds outstanding, they were resetting at predetermined maximums, some as high as 20%. All told, the turmoil, it left at least 41 states and the District of Columbia with shortfalls that would take years to recover from. Municipal bond investors, they were decimated, losing about 8% in 2008 when you include reinvested interest. That's according to Merrill Lynch's Municipal Master Index. And a separate Bloomberg index for high-yield munis, that plunged a record 27% that year alone. Those were the worst annual performances for muni debt on record then, and still remain the worst performances on record now.